Okay, hi guys.
Welcome everybody.
Look, this is a smaller group, and so if you all are comfortable, we could kind of more of an informal conversation. And discuss each one of your situations, if that's what you all would prefer, or if you'd like, we can go forward and just explain everything and you guys just ask questions. Can you like hit the raise hand icon if you want us to do the informal, discuss your individual situation and kind of broadly talk about ERC, or would you let's do that. Raise your hand if that's what you would like to do. Unmute yourselves and we kind of just have an informal conversation. Negative.
All right, let's do it.
Okay. We're happy to do the presentation. So we will go forward with it. So obviously my name is Rebecca. And Peter. We are the supervising attorneys in like the special credit division of Cross Law. And we started this really organically. We were tax controversy attorneys. Both of us have practiced for well more than a decade and working with small businesses that are kind of on the bubble of viability with tax problems, payroll tax, sales tax, what have you. And then what happened is, a global pandemic hit all these people and we had to figure out how to keep them in business. So we dug down deep into the CARES Act. And first we started with PPP, helped our clients get those loans and, the forgiveness of those loans, worked through all the different iterations. If you all remember that, was kind of very problematic. Guidance was coming out every few weeks, went from 8 weeks to 24 weeks. The rules kept changing. And so Peter and I were keeping up to date with all of that. And if you recall, in the beginning of PPP, you couldn't use it with ERC. So no one really paid attention to the employee retention credit. It was something that we discovered later in that it was much more lucrative to do PPP. So it was like 15,000 and then 20,000 per employee. ERC was 5 per employee. So we spent our attention there. Then in December of 2020, Congress changed the rules and said, you can use ERC and PPP together. And that is when we started getting our clients the employee retention credit. And that was a credit that actually paid off all of their tax liability or a huge portion of their tax liability. In some cases it overpaid and actually got them refunds back. And we realized what a great opportunity this was. And we were able to, project out and kind of take this, informational campaign to viable businesses as well and to help other industries. And we've partnered with, the National Restaurant Association. We've partnered with Maryland Child Care Organization and working through their employee retention credit needs and whether or not, they're eligible to get the credit. So I say all of this just to tell you that we've come through this very organically. There are a lot of companies, and I'm sure you've heard them, that kind of popped up overnight, are blitzing with ads and robocalls and all kinds of things. That's not us. We, really distinguish ourselves from those types of organizations in that we did this to help our clients, and we're happy to share the information that we learned with all of you. So with that, I'll send it over to Peter.
And so, we are a big group. So we did make this so you can unmute yourselves and ask questions. We'll pause at certain points because certainly we understand where a lot of the stuff gets hard and, it's what we see all day. And so we'll slow down at certain points, but big picture, what are we going to accomplish today? We're going to go through the background just to, establish what we're doing, how we got here. We'll talk through eligible employer analysis and, the theory of the case with some of these ERC credits. We'll talk briefly about the qualified wage computations and issues related to that. We'll talk through substantiation and what you need to be saving and being able to show the government in the case of an audit. And then we'll talk through, at a high level, some of the stuff that makes this really tricky, because this is a lot of existing tax law that is sort of, part of ERC that I think a lot of people aren't really appreciating. So, just to jump in here, background, Rebecca mentioned some of these things, but just to, refresh yourself about what was going on during the pandemic and all these different programs that were flying at you. PPP, Paycheck Protection Program, was of course the big one. It was worth $15,000 and change at first, per employee, and so that took all the air out of the room. And if you could qualify for PPP, you went in that direction. So why even look at ERC? Family First Coronavirus Response Act was a situation where if you were paying wages to an employee who was homesick with COVID or caring for a close loved one, there were credits available there. There were deferred payments of Social Security tax. If you deferred payments or you had a client defer payments, or somebody who deferred payments, those should have been repaid by now. The second tranche was due December 31st, 2022. So make sure you make those payments if you haven't already. Then there was the employee retention credit. Again, it wasn't getting much love. At first, it was only worth $5,000 per employee. Again, so everybody was looking at PPP. And then they came out with some specialized stuff: Restaurant Revitalization Fund, RRF, Shuttered Venue Operators Grant, SVOG, and then there was the EIDL loan program, Economic Injury Disaster Loan, where basically the president said every place in America is a disaster, and it opened up the opportunity for some pretty favorable loans from the Small Business Administration. So, the trail of legislation that Congress has left here for us. So the initial CARES Act included ERC, as Rebecca said. That was March 27th, 2020. And the rule was you got to pick a lane. You can't do both. You get one, you can't do the other. And then December 27th, 2020, it completely flipped it. And they said, hey, just kidding. You can't actually get both. And actually, not only can you get both for 2020, you can actually get it for the first 2 quarters of 2021, and those are more lucrative and a little bit easier to get in some situations. So we'll talk through, those issues as we go through the eligible employer. But then, new administration comes in, new Congress, they come out with this American Rescue Plan and say, hey, not only can you get it for 2020 and also the first 2 quarters of 2021, you can also get it for the second or the third and the fourth quarters for 2021. Great. And we started advising clients based on, the American Rescue Plan and the implications of that. And then, just to mess with us, I assume, and to keep everybody else on their toes, they come out with the Infrastructure Act, November 15th, 2020. And they say, well, we were just kidding about that. And in most circumstances, we're going to pull back Q4 eligibility of 2021 and limit it only to Q3. There's some exceptions to that, and we'll talk through those. This page is really just to, make sure that, we're not making this stuff up. But this page really represents the government's effort to help interpret the statutes, the law that was on the previous page. It has not been as robust as PPP by any stretch of the imagination. Notice 2021-20 is really the big one. 23, 49, and 65 sort of track the subsequent legislation and the interesting things that happen after they do a little tweaks here and there and change the program a little bit. These revenue procedures 2021, 33, and 48 have to do with what to think about some of these other programs and the interaction with things like PPP and RRF and SVOG. And how you take that into consideration when dealing with the employee retention credit. Then this last slide is the last sort of intro or background slide. We learned actually teaching attorneys about this stuff that not everybody understands the payroll tax basics. And we were well into this presentation and we had to backtrack because one of them said, I don't know what the heck you're talking about. This is not PPP. PPP was, you know, an ongoing conversation that you had with the bank. They were asking for stuff, you were sending it in, they were blessing what you were doing. This is a different program that was built on top of sort of the payroll tax regime and filings and payments and all that kind of stuff. So normally that's done on Form 941 that, you know, an employer files quarterly, they self-report the wages and self-assess employment taxes, withholding, Medicare, Social Security. That's what we're talking about here. When we get into some of the next couple slides and we start talking about a credit of this and that and whatever, this is just Congress, you know, made a choice that they are going to, that this is going to be the mechanism to, you know, claim this credit. So don't get too bogged down in this idea of 941s and 941Xs and all that kind of stuff. Just know that this is different than PPP. It's built on, you know, quarterly filings. And then we'll get into some of the details as we go.
I don't know if you all noticed, but I gave Peter a nice little like, and this is Peter. He'll go into this. Peter just stops talking and makes sure that I'm paying attention.
Paying attention.
Fun game. What are we talking about? What is the employee retention credit? It is a refundable cash credit that a business is eligible for. So this is a big deal and a big difference than other tax credits, which are carry forward, blah, 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 for 20 years, and you don't really feel like you're getting the benefit. And so it doesn't feel like it's worth it. This is very, very different. This is for every quarter of eligibility. So Peter was talking about the payroll tax, 941s. For every 941 that you're eligible for, you are going to receive a refund from the government. So if you're eligible for 5 quarters, you're going to get 5 checks. That is very, very different than the way most, you know, tax credits work. There are different rules for 2020 and 2021. Like I said earlier, for 2020, the credit was $5,000 max per employee, and that is 50% of up to $10,000 in qualified wages for the entire year. I really think that Congress thought we were going to turn off the economy for 8 weeks. Everyone was going to stay home. COVID was going to go away, and we were going to turn it back on. Everything was going to go back to being fine. Well, in December of 20, they realized that was a mistake, and they made the program much more beneficial and easier to get. So for 2021, the credit is 70% of up to $10,000, but instead of a calendar year, it's a calendar quarter. So for every quarter of eligibility in 2021, you can get $7,000 per employee, bringing your total up to $26,000, assuming you're eligible for every quarter. That is a very big difference than you know, just that $5,000. So how do you get it? What's an eligible employer? Term eligible employer means an employer that was carrying on a trade or business during the calendar quarter for which the credit is determined. And there are 2 ways to qualify: either a significant reduction in gross receipts or a partial suspension of operations. The first way is the easiest way: significant reduction in gross receipts. Peter and I tell everyone to do it this way first, because if you qualify this way, you don't need a long-winded legal analysis about your qualification. So the gross receipt test for 2020, 50%. Your gross receipts had to be reduced by 50% quarter over quarter, 2020 compared to 2019. That is a challenging definition for lots of folks, but lots of folks still made it. So if your gross receipts went down 50% in 2020, quarter over quarter, then you can be an eligible employer for 2020. Now for 2021, Congress made this a little bit easier. They said, okay, all you need is a 20% decline quarter over quarter for gross receipts. Makes a very big difference. And they also added something called the alternative reference quarter for 2021. The alternative reference quarter allows for automatic qualification for successive quarters. So that means that if your revenue went down 20%, say in Q4 of 20, then you're going to automatically qualify for Q1 of 21, even if your receipts went up 130%. It doesn't matter. We have had quite a few folks get upset about this. They're wondering how they can qualify if the quarter went up. And the rule says very clearly that the alternative reference period allows successive quarter election. So it doesn't matter whether or not that
and to be clear, it's not even a rule, right? It's straight from the statute. Like this was something that was inserted into the actual text of the statute. So it's not relying on some interpretation or something like that. It's very straightforward.
All right, so that's the easy way to qualify. The harder way to qualify, and the thing that Peter and I spend 80 to 90% of our day on, is a full or partial suspension of a trade or business. This is the legal analysis I was talking about before. So what if your gross receipts didn't go down by the requisite amount? What if your gross receipts went up? Can you still qualify as an eligible employer? And the answer is yes. It just gets more tricky. So gross receipts, black and white. There's no question of eligibility. As long as you did your books right and the profit and loss statements are correct and all of that, receipts went down, you qualify. This next test is squishier. A full or partial suspension of trade or business. So the operation of your trade or business is fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority limiting commerce, travel, or group meeting due to the coronavirus disease 2019. So the gross receipts, you can go down for any reason. You closed 3 locations, your gross receipts went down, you might have been doing it anyway, doesn't matter, you qualify. This, it has to be due to COVID, and the government has to actually be suspending your trade or business because of COVID. So we look at it as like eminent domain. The government's coming in and they're paving a road in your backyard. Doesn't matter if you're using your front yard mower. As long as that road is paved in your backyard, it's a taking and you're not able to use it, then you can qualify for the suspension of trade or business. Now, there are 2 tests here. It has to be more than a nominal portion of your revenue, and that is your 10% of your revenue or hours worked in 2019. So let's look at an example. A restaurant. Larry Hogan said, you are eligible. I'm sorry, not you are eligible. You are essential. You should be open, serve food to the masses. You're good. But like, you can't.
For those of you who may not be in Maryland, that is our governor, our former governor.
That is our former governor as of yesterday. Correct.
Yes.
So Governor Larry Hogan of Maryland said on March 16, 2020, restaurants should be open, support your local restaurants, but you can't come inside. So restaurants could still do carryout. They were still open, but a portion of their business was suspended. That in-person dining option was suspended. Now, if that revenue was either 10% of gross receipts or hours worked in 2019, that dining room revenue, while that was fully suspended, they are going to be eligible. At this time, it does not matter if you crushed it in DoorDash or if you crushed it in delivery, because all you're looking at is my 2019 sales were more than 10%, and I'm no longer able to do this. Now, in, I think, June of 2020, those rules changed, and now we go from the nominal portion test to something called the nominal effect test. Now, gross receipts is black and white. Nominal portion test is squishier. Nominal effect test is even squishier. So now you can be open, but you have a 50% capacity in your dining room. So how do you know whether or not your business was affected? You need to determine whether or not the government restrictions, the 50% capacity limitation, or 6-foot social distancing, or extra cleaning measures, depending on what type of business you have, whether those restrictions had more than a nominal effect on your business. Now we're looking at current conditions, and we're trying to determine whether or not you're able to provide goods and services in the same way as you could have if there were no restrictions. And if you aren't able to provide goods and services by the tune of 10%, you could do 10% better, then you have a restriction that has more than a nominal effect on your business. So this is hard. How do you determine whether or not you can provide goods or services 10% better? You have to look and try to figure it out. So if you have a dining room, you had 20 tables, 50% capacity, you're at 10 tables. Well, your carryout went up, but you still believe that 10 tables is more than 10% of your overall sales. Now we're looking global, right? We're looking at DoorDash, we're looking at carryout, and we're looking at in-room dining, in-person dining. We're trying to make a decision about whether or not you qualify because the restrictions had more than a nominal effect on your business. And this is kind of what we spend all of our time on, to figure out, well, were they able to provide goods and services? Oh, but their gross receipts went up. Why did their gross receipts go up? Oh, because they hired 5 more people because they needed to help effectuate waiting room lists, or they weren't able to have as many customers during the day, so they had to expand hours. And because of that, they had to pay all these extra people to staff it, or they had to pay extra utilities or things like that. And this is what we'll find out from you if you're trying to make a determination of whether you're eligible. We're going to be going down to like a pretty granular level to see, you know, how is your business impacted during all of this? And that's the nominal portion, nominal effect test.
So I'll just say a couple of things about,
Yeah.
I mean, I agree. This is where this stuff gets hard. Congress didn't do us any favors in, you know, the legislation itself, and certainly the IRS didn't really help us out too much, you know, with the Q&As in Notice 2021-20. It's clear, I think, that the nominal effect stuff is different than the nominal portion stuff. And basically what they've said about, well, what do we think about this nominal portion? Again, you know, both of these tests are facts and circumstances. So when we get into these 10% tests, these are their situation. The language that's used is, we will deem it to be a more than nominal portion, or deem it to be a more than nominal effect, you know, in these certain situations. So what did they say about nominal effect? They said, you know, we will deem it to be a more than nominal effect if your ability to provide goods and services in the normal course was impacted by not less than 10%. 10% of what? It's not clear. It doesn't necessarily put you back into the same, you know, gross receipts reference point from the nominal portion part, or hours worked. It can be temporal in nature, I think. So if, you know, pre-pandemic, you were able to get your product to market, you know, in 2 weeks, and now because of these governmental orders, it's taking longer. But then how do you know it's the governmental orders? Could it just be that you had bad employees, or your management wasn't effective? So this is, when Rebecca uses the word squishy, it's squishy. And it's like squishy.
That's a legal
like,
term. I paid a lot of money for a law degree, and I learned that different things have different squish levels.
well, and it's like squishy wrapped in like an oil slick. Like it's even like worse than that. And, you know, you've got to get to a situation where you feel comfortable 3 years from now, and we'll get into audit and stuff in a little bit, sitting across the table from a revenue agent and saying, these are all the ways that the governmental order jammed me up. And, you know, Rebecca said, could gross receipts go up and you could still qualify? I agree. I think the answer is yes. But boy, is that low-hanging fruit for a revenue agent to say, look at this data point. You know, your gross receipts went up, and you're like, well, yeah, but that's a fact and circumstance. It's not the only fact and circumstance, right? So now you're in this really tough situation to have to work through these issues. You know, Congress knew how to make a means test. They did one in method 1. You know, method 2, IRS has said these are facts and circumstances. So I agree with Rebecca that you could have a situation where gross receipts go up. But I also want to look at, you know, net profit, right? So there's different metrics that you want to get in there. And, you know, what happened after the restrictions were lifted? Do you see a situation where there are data points where it goes up? These are the things that someone you are working with on this credit should be challenging you on, to make sure that you are thinking through the the arguments you are making. I did a call yesterday with someone who, said, I have this client that claimed they didn't tell me, this is CPA, and, they basically told him that because you were part of the construction industry, even though you were able to figure it out and find a new supplier for what you needed, and gross receipts went up 130%, they said I was fine to claim it. We're fielding calls like this all day, where just a lot of these organizations are blowing past this nuance. And we'll talk about some of that as we go. As we go, we're still talking about eligible employer. So step one is, determine that you're an eligible employer. There is actually a third method that was introduced by the American Rescue Plan, called a recovery startup business. These are businesses by the definition that began operations after February 15th, 2020. If you started operations before, so sorry, you can't be a recovery startup business. The average gross receipts for the business were less than $1 million annually. That is one of the big sticking points with this, and we'll talk about controlled groups of corporations, but keep that in mind, because you've got to do some additional tests with that, and we'll talk about it on a later slide. By definition, you don't qualify under method 1 or method 2, so they put you through that analysis first. And then this credit is only for Q3 and Q4 of 2021, and it's the only way to qualify for Q4 2021. The catch is that each quarter is capped at 50,000. So, if you're able to satisfy that recovery startup business definitional stuff, you're up to $100,000 before you're maxed out. So what is this? Congress decided that they wanted to reward somebody who took a risk and started a business during a pandemic. They survived into quarters 3 and quarter 4, and not only survived, but still had employees, or grew to a point during that period where they had employees in Q3 and Q4. Couple of points just to point out on this. Each of these are standalone tax returns. We mentioned that this is building on 941s and amended 941s and these quarterly returns that you're filing. Each of these is a standalone analysis. So, you could be a recovery startup business in, Q4 of 2021, but maybe you were restricted under method 2 in a prior quarter. And maybe you're able to show a significant decline in gross receipts in another quarter. And certainly it is contemplated that a business could qualify under all 3 methods under the right circumstances. So when you're doing this with someone, make sure that they are explaining to you the theory of the case, because information document request comes out from IRS. They're going to ask you, how are you an eligible employer? And we'll talk through some more of that kind of stuff soon. So that's really been the eligible employer analysis. Bear in mind, you could be an eligible employer all day long and have never paid a single qualified wage. So it's really a 2-step process. Generally speaking, for the vast majority of employers, qualified wages are just wages paid to your folks. It includes things like tips. It includes things like health plan expenses. What happens, though, is there's a definitional twist here if you are considered a large employer for purposes of the credit. And again, to keep everybody on their toes, there's different rules for credits related to 2020 and credits related to 2021. But basically, the policy here that's coming through is we want to help the little guy. Congress wants to focus on a smaller employer because the bigger employers are probably better positioned to weather the storm. So what they say is go back and look at 2019. And if you had more than 100, averaged 100 or fewer full-time employees, or 500 or fewer full-time employees, and that's this slide, the 2021 rule, then you can pay whatever qualified wages, or they're just wages paid to your employees during the period of eligibility. If you are over that 100 or 500 cap, however, what happens is it changes the definition of qualified wages to only those wages that were paid to employees who were not providing services to the employer. So you were basically paying somebody to stay home. What, I guess a couple of quick points about that. One is it's not a cliff. So you could pay someone both to provide services and not to provide services. So if you paid somebody 15 hours because during that time, that's all the help you needed, but you capped them off at 40 hours because you have a long relationship with these folks and the other families or whatever, you're just doing the right thing. You paid them an extra 25 hours, that 25 hours, you're paying them not to work. And so, that would count as a qualified wage for the purpose of this rule.
Just we had a question about where to get government orders on shutdowns, and just before we get too far from there, I just wanted to quickly answer Anthony's question. So do you know where you can find the exact dates of DC's various shutdowns? You've got to actually go in and find the executive orders from the mayor or the health department and pull them down. A lot of these are starting to change over. So you might have to call the health department or actually the mayor's office and ask where they are. But that's what we found. So back to Peter. Sorry about that.
No worries. The Wayback Machine is a thing. The internetarchive.org or something like that. And you're really at the mercy of whether or not this nonprofit happened to scan that corner of the internet on any given day while that order was posted. So, we'll talk through timing and due dates and that kind of stuff, but time is of the essence for sort of non-filing reasons. Maryland here, we just got a new mayor yesterday, a new governor yesterday, and the old governor's website is down and the orders are all down. And, that's going to start to make these things challenging. Dramatic pause for Rebecca to realize it's her turn.
I know, my turn. I was just getting it off mute. Where'd you go?
Huh?
I don't see you. So limitations and refunds. So qualified wages. So eligible employers first. Are you eligible? Let's find out. If you're eligible, does that mean you get automatically the ERC? No, now we need to look at qualified wage. So that's what Peter went through. Now these are limitations on your qualified wages. So it does not exceed $10,000 for the eligible employer for 2020 for the whole year, 2021 per quarter. Like he said, the recovery startup business is limited at $50,000. Those are just a couple of points we've already said just to kind of make sure they're hitting home. But one other item that's really, really important is that the refunds of excess credit, like I said, is a cash refund. So you're going to get that in your pocket, and we'll go through the taxes and that kind of stuff later. But essentially, you could take it as a distribution for you, for the owner, for the ERC. So that's a really, again, cool part of this program is that it's cash to the business. It's not something where, in 3 years they'll discover all of the credits. Next slide. Okay. You can't claim the same dollar twice. So when Congress said you couldn't use PPP and ERC together, they were worried that people are going to have $10,000 in wage and take it for PPP and take it for ERC and take it for FFCRA and all of that kind of stuff. Here, this is very clear. You cannot do that. So what we do when we prepare our stuff, and I know there's some CPAs on the call, so I would recommend that you all do the same thing, is create a work paper. I paid Peter $20,000 in 2020. I got $10,000 for PPP and $10,000 for ERC. You want to see the employee, each employee. So if you've got 100 employees, you're making a very big work paper. And then you're going to be cutting out any other type of aid. If you've already filed for forgiveness, which you should have, you can't amend those. So a lot of people, when they're filing for forgiveness, clearly missed me and Peter's, PPP talk, where we said to make sure you're maximizing your non-payroll expenses. But here, if you just took all payroll, you're going to have to use those numbers. You don't get to go back and say, okay, well, I did have rent. Like, why can't I use this? You're going to have to make sure that you're calculating the numbers properly and that you're showing it. Because in 3 years, if the government asks you, how did you get this number? How did you come to this point? You're going to want to show them a work paper to show exactly how you calculated it. In addition, I know we're talking about the Wayback Machine and government orders and all of that stuff. It's super, super important that you are keeping a copy of this. If you are the business owner, this is on you. Keep everything. You need to show how you're an eligible employer and what the qualified wages were. So why you're eligible, that squishy stuff, write that down, explain it, use your profit and loss statements, show the footage of people leaving the drive-through, whatever you need to do to make sure that you have a file ready to go if the IRS asks you about it. You're a preparer. This is your job to get to your client. Make sure you're giving them all the government orders. So, like Peter was saying, those things are coming down. In 5 years, when these things are audited, are you going to be able to find the government orders that showed November 13th, 2020 through December 31st, 2020 that you were still restricted? You're going to need that. In addition, you're going to need to show how these other credit programs played into it. Now, RRF is super weird in that it became a thing after a lot of ERC was already done. And so you can actually double dip RRF for Q1 and Q2 of 21, but not Q3 and Q4. That's super unique fact pattern. So if that's a thing that you have a question about, feel free to reach out. Next.
I'll just say, we started this with the nominal effect stuff and the really hard, or the eligible employer stuff, and the really hard stuff in that area is the nominal effect test. This is the stuff, the interplay with other credit relief provisions is what's really hard on the qualified wage analysis, because you're going through and you're looking at the payroll data and you're saying, okay, well, when did this person get paid? Because, on the legal side of this, when we're doing the eligible employer analysis, we're giving them we're giving the accounting team a precise start date and end date.
Eligibility period, yeah.
Eligibility period. And they are then looking at, the payroll data and the covered periods related to, this stuff. And we'll talk through family attribution rules and controlled groups. And like, that's where this stuff starts to get really, really hard, is making sure that you're not taking an inconsistent position with something else that employer has going on.
I'm here, guys. Don't worry. I'm here. How to claim it. So Peter likes to be the wet blanket in the room, so I like to be a little bit more upbeat. But he's absolutely right that this stuff is really, really important to make sure you're getting it right. You make a mistake, and we like double check each other all the time. You make a mistake by 3 days, that can affect the credit by $50,000. That is a really big deal. So definitely make sure you're papering your file, double checking yourself, talking to your client, making sure there's informed consent. Like, as they are signing these returns, they understand your theory of the case. They've got the government orders. They can review them. Yes, I was restricted. Yes, these restrictions had more than a nominal effect on my practice or on my restaurant or on my law firm or whatever it was. And they're signing off on that. How do you get it? The 941s. Peter always laughs at me because I say I hate the 941s like well before COVID came into play. In 2014, I had a nanny and I did my own payroll, which was a nightmare, and I hated it. The 941 form has gone like 3 times as long now, and it's definitely a pain. So make sure you're being careful, you're filing the forms properly. When you send in these forms, you want to do it in the way you would do any tax return, individual envelopes, don't stack them all together. Make sure that the IRS has a fighting chance to process it properly. Go to the next slide.
I just have to say, this is a good opportunity. Someone handed me this thing a couple hours ago. A letter from the IRS. To Rebecca's point about mailing them all in and being able to prove that you filed. Says our records show we received your return on October 10th, 2022 for the tax periods listed above. We're sorry, but we can't find it. So we need your help to finish processing your return. That stuff's happening too. Just FYI.
If you thought that the IRS was going to do a really good job in this case, you must be Congress because you thought this was a great idea to do this all via paper. So they've had some hiccups. With the forms, this is a worksheet that is going to determine how much the credit you're getting. So the PPP work paper, all of that's going to give you your qualified wage. Well, this is going to take your qualified wage and break down exactly what that means as far as what the credit is. Now, you don't file this. So if you are getting this from a preparer, make sure if you have 5 returns, you want 5 worksheets in your file. If you are a preparer, make sure you're giving this to your client. It's super important that they have it for their records because the IRS says very clearly, keep for your records. And when they audit things, they want to make sure that, the things that they asked you to keep, you've kept. So just to kind of give you an example of what each one's going to look like.
But beyond that, to the CPAs who are on the call, like, I know you guys are really wanting like an example to run through, right? The problem with this whole thing is that the step 1 conclusion on this worksheet, which starts it all, is in and of itself a conclusion that you've worked, in an Excel workbook or, chicken scratch on a piece of paper trying to figure out how do I even answer the first question. And that's why, because we monitor the other sort of trainings and stuff that are out there and see what other people are talking about. And there's just not that content because it's really, really difficult to try to work through something like that. All right, everybody, get excited. This is my opportunity. This is my opportunity to be a wet blanket.
Yeah.
So, the IRS came out with the notices and then largely were silent on this while a whole industry grew up around it. Fly by night, pop-up shops, folks who weren't tax professionals or working with numbers or accounting or anything in this space are doing this stuff. We had a colleague who was talking to somebody who was doing this work and said, oh, what's your background? He said, oh, I build houses, but I heard this was, a pretty lucrative industry. There is a lot of junk out there, and it took the IRS until October to acknowledge it, but they have. They've come out and they've said some third parties are taking improper positions related to taxpayer eligibility for and computation of the credit. Improperly claiming the ERC could result in taxpayers being required to repay the credit along with penalties and interest. Audits are starting to happen. And by and large, they are happening exactly how the government said they would happen. In QA 70, they tell you exactly what you need to survive an audit. Just recently, Rebecca forwarded this to me this morning. Small business self-employed commissioner came out and said, this has been a very ripe area for fraudulent activity. I was at a conference in Las Vegas in December, tax fraud and controversy conference, and there was both civil enforcement who is saying, look, we're adding this to the dirty dozen list. There are going to be audits. There are going to be promoter penalties. We are looking at this very closely. Civil was very tight-lipped about exactly what they were doing, other than to say, believe us, it's on our radar. You go to the next panel and it's the criminal panel, and they're saying, oh, absolutely, our special agents are looking into this stuff. We are building out cases, and even if they don't rise to the level of criminal, we're punting it over to the civil and we'll let them finish, that way. So whoever you work with, or if you do this yourself, you need to slow down and appreciate the nuances with this and the parts of this that are really hard. Not everybody's eligible for 6 quarters. And we're seeing that kind of stuff with some of these shops that have popped up in this space. So now that I've scared you, substantiation for claiming credit. This is QA 70. So this is 2021-20 QA 70. It says, what's the government going to want for you to substantiate it? So governmental orders or ordinance that caused a full or partial shutdown. We've touched on it several times now. Orders are coming down. But not only are they coming down, but just remember what you're out there looking for. this wasn't a situation where a governor or a mayor or a county executive made one proclamation and it lasted until it ended. These things were, put in place, reissued, amended, tweaked, changed. Maybe they went away for a little while and then came back in the winter when COVID reemerged. Whatever it was, you've got to find them all and you've got to trace it. And these things can go hundreds of pages long. And it's not just, federal or governors. It's like I said, mayors, county executives, health departments. It's an appropriate governmental authority that you've got to be able to find. If you qualify based on a significant decline in gross receipts, you need to be able to prove it. Generally speaking, like Rebecca said, if you're doing your accounting correctly, you're a cash basis taxpayer or you're accrual basis taxpayer, you're recognizing those receipts appropriately, you're turning over quarterly P&Ls. And as long as that all ties out, you should be in good shape. That's why we say it's most black and white and start there. Records of qualified wages is probably the easiest. This is just your payroll data. Large employers. So again, if you had more than 100 or more than 500 full-time employees, you have to have evidence to show that the wages were paid to an employee was not providing services. That's challenging, right? You're proving a negative. So probably you're wanting to hold on to timesheets and the like, schedules. Documentation for health plan expenses. So this is definitionally part of a qualified wage. Typically, health plan expenses may sort of top someone off to get them up to that $10,000 qualified wage threshold. It can add a couple of percentage points to a
credit.
Rebecca just chatted me and I looked at it and I got
Oh my gosh, it's my fault. Get out of here.
all right, documentation.
Add a little bit to your credit because you're topping off the qualified wage. So it's not going to move mountains. It's not something we typically take into consideration for an estimate, but we always get it and make sure we include for anything later, for anyone who's not maxed out otherwise.
And tips though too. I mean, keep in mind tips work if you're in an industry that has gratuity. Aggregate group employer determination we'll talk about on the next slide, but that's going to be a big deal.
Natalie has a question in the Q&A about that, so you can hit that while you're talking.
Form 7200. This was a thing where the government thought that they were going to actually advance people the money before they even had to file the 941s. It didn't work, and it's over now. You file a 941X. And then keep copies of your employment tax returns. The government says to keep it for 4 years. I don't know if they updated the notice once the American Rescue Plan extended the assessment date. You should keep it for 5, and we'll talk about why after that. So special issues. These are the things that seem like one-off references when you're reading the CARES Act or the subsequent legislation where it says, pay attention to section 52 or 414. And as you're reading it, you're like, oh, I don't know how important that is. I'm looking at all this other stuff. I think a lot of people are missing this. So controlled groups, affiliated service groups, management organizations, these are all things that existed in the tax code pre-ERC. And they make a big impact on what to think about the credit, becoming an eligible employer, all of these things. So, and it matters how you're trying to become an eligible employer. So if you're trying to become an eligible employer, and just big picture, controlled groups are, a parent subsidiary where the parent owns more than 50%. Brother sister control groups have a controlling interest test and an effective control test. So you got to meet both. Or there's combined groups, basically common ownership. So if you're looking at this stuff and you've got ownership, you need to understand, or if you got business partners, you need to understand what they own. You need to understand what their spouses own. You need to understand, weirdly enough, do they have minor children in this situation, children under age 21? Because it matters, because if you are trying to qualify on a significant decline in gross receipts and you only look at one of the entities in the controlled group and you didn't look at the rest of them, you've done it wrong. Now it's a little bit different on method 2, where you're trying to qualify a trade or business operation. In that situation, you're looking at trade or business, and that's a term of art. So if you have a restaurant in a controlled group, but also a construction company, and they're using different employees and different managers and keeping different books, you can sort of focus just on the one that you think is the restaurant that may qualify. Then just on the method 3, recovery startup businesses, if you have a controlled group, that $1 million test becomes harder, because you have to consider the receipts from the other operating businesses as well in order to evaluate whether or not you fall under that $1 million average. Again, family attribution rules do apply. So, if you've got parents that work with you, grandparents, kids, again, minor kids under age 21 have this whole, special rule. Spouses can be treated, the default rule is that they're going to be treated as owning each other's businesses. There's some exceptions to take notice of. So slow down, work through this. Second bullet point, majority owners, so greater than 50, not 50-50, but greater than 50 owners and deemed owners' wages aren't qualified. Deemed owner wages, again, this is existing tax law, or at least the government's interpretation of it, that is grabbing close family relationships, and actually not even that close. It's grabbing in-laws and step relationship folks that work in the business. So you got to know who's working in the business to work through the qualified wage stuff. Sole proprietor income isn't qualified. That's different than PPP, where everybody was asking for net business income on line 31. Sole proprietors can still have employees, but they're not going to qualify based on their net business income. If you acquired a business or a part of a business during COVID and you're trying to qualify based on the significant decline in gross receipts, slow down. There's a safe harbor, and sort of helps you think about, well, what do I need to know about this business during the time that I didn't own it? How do I evaluate this? Work through that. To Rebecca's nanny, so sorry. Household employers aren't eligible. That was just a rule that they decided on. Statute of limitations. So this is important stuff. The ASED, the assessment statute expiration date. This is the amount of time that the government has to come in and take a look at what you've done here. Generally is 3 years. And this cuts off from the time of filing. So when you file these, it's re-upping your time. ASED was expanded, not 5 years, but to 5 years total for quarters 3 and quarter 4. So they basically gave themselves an extra 2 years for these last quarters when they came out with the American Rescue Plan. The refund statute, however, is not extended. This is what's going to determine your due date. So claims related to 2020 calendar quarters are due April 15th, 2024. Claims related to 2021 are due April 15th, 2025. So you still have a little bit of time. There's no rush yet, other than some of these things are taking time to process. And then, the big catch, or the biggest catch of them all, is another existing code section, 280C, says that if you get a credit based on wages paid, you lose the deduction for the wages up to the amount of the credit. So what does that mean? It means you're going to pay tax. It means you've got to go back, amend your 2020 or 2021, income tax return. If it's a pass-through, you're going to have amended K1s. It's going to require amended 1040s. But there's going to be a tax due associated with this. So, it's not the end of the world. I mean, in almost all circumstances, when we're talking with someone, it still makes financial sense to claim the credit, just because of how the computations work and how quickly, you can add up to a big number. Frankly, the way Congress did this with the 70% of $10,000, it adds up quickly if you're eligible in 21, or $5,000 or $5,000 for 2020. So I just remembered, Rebecca, that you told me there was a question. Did I answer it?
Natalie, did Peter answer your question? He explained aggregation, but do you understand it? You can unmute yourself and just talk. Essentially matters who the other owner is, right? Your 50-50 owner, with somebody else, does it pull into another business of that 100%? It matters, who that is.
Like
because-
if it was a spouse, you got some family attribution rules that could trigger a situation where that would happen. Generally speaking, though, if they're unrelated, don't live with each other, there's some weird rules around, your primary residence. You wouldn't be able to meet the 80% controlling interest test. Natalie, if you want to give me a call, we can work through specifics, but probably not going to be any control group there.
They aren't related, then you're probably fine. It's hard to give like affirmative legal advice based on one sentence without knowing more. But it seems like you'd be fine.
So at this point, we're happy to answer any other questions. Please unmute yourself. We can have a conversation. I mean, the ones of these types of presentations where people unmute, you get into a decent conversation with everybody because somebody's thinking the same thing or wondering the same thing. Or
Peter, Anna Marie, my apologies, said, does rental real estate count as a trade or business when looking at control groups?
boy,
That's a great question that we cannot answer in 30 seconds. There's a lot that could go into that as a yes or a no. So I would say just reach out to us on that offline. Our emails are here.
yeah.
That's a tricky one. I don't know how to unmute. No worries, Natalie. So you can keep using the chat. Don't let Peter shaming you into making sure you speak.
No, I'm just always afraid to click on anything while I'm also running the slides, and then my email inbox ends up on.
Can you see the G chat I sent? No, I'm just kidding. So this is also usually where I say, look, like Peter and I have spent way too much time on this stuff, probably like thousands of hours. Not probably, thousands of hours we've spent learning this stuff, figuring it out. We still have stuff we don't know. We're still figuring it out on certain things. We feel very strongly in the fact that like this is our knowledge base at this point, and we are happy to share it. This stuff won't be cool for forever. It's really only for another couple of years, and then with audits, but then it's going to be a dead area of the law. So while we're cool,
Until the next pandemic.
Pardon, until the next pandemic, and then guys, we're going to be so good. But for now, we're like Def Leppard in the 1987. Like we are at our moment. So feel free to reach out anytime. If you're an accountant, you don't have to wait until the third Thursday of the month or whatever the February one is. You can shoot us an email, just ask us a quick question as you come across it. We truly don't mind. I think that also like speaks to like our level of confidence in the space.
Anthony, Anthony asked a question about the due date. So the way it works in not March of 2024, but April 15th, 2024. So the way it works with employment tax returns, these 941s, yes, I agree with you that they're due, progressively throughout the year. The code actually deems them to be filed the following April 15th. So, for example, all of the 941s that you're timely filing through 2023 won't be deemed filed until April 15th, 2024. And then if you're trying to evaluate, well, when could I go back and fix these 2023 returns? You'd be 2024 plus 3 years, so 2027. So that's a definitional thing, a tax code thing. So that's why, it's our opinion that the due date wouldn't be until 2024.
Okay, hang on. There's a bunch of stuff in the Q&A. Natalie does not like the joke about more pandemics. Natalie, we just don't want to become obsolete. We don't know what's happening. Anna Marie, sale of rental real estate net gain needs to be included in gross receipts. Again, that kind of stuff, like if the business sold a rent, like sold something in during the years at issue, yes, that would be involved in the gross receipts, but that kind of stuff has a lot of different pieces. Like, is it the business? Is it the owner? Who's selling it? Is, you know, active, passive, all of that kind of stuff. So it's not something we can really answer off the cuff. Anything else that people would like answers on?
And I apologize, Natalie. I did not mean to be crass like that. To Rebecca's point, we're just trying to share the knowledge.
All right. Well, it looks like, nope. One more. Natalie says she's joking.
Got it.
We're all good.
But it is, I mean, Natalie, to that point, it is, you talk to people about this stuff. We're in the weeds with somebody on a nominal effect analysis or something like that. And you're talking to them, and they're like, I am so sorry. I just have to say, pandemic was really good for us. And that's when you're like, yeah, I know, like there was a lot of these programs, you're probably not eligible, you know, and so it's just a weird, it's a weird space.
It's weird and people feel bad about it. Like my tax clients, that all of their liability got paid through their restaurants. They did really well with carry out, but the dining rooms were closed, like all that stuff. Like, Rebecca, I hate to say it, but like this saved our business. And I'm like, look, you didn't ask for it. You weren't like, you know, I hope this happens and therefore my business will be saved. Like you take advantage of opportunities that are in front of you and that's all you can do. That's the same thing here. It's like, you do the best you can with what's in front of you. And if you can get credits for your clients, you know, this isn't the same thing as PPP where it's like, you have to check a box and say, I'm unsure about present economic conditions. How am I going to survive and all that kind of stuff. You're in a position where you're saying, my gross receipts did X. My dining room is closed. I run a bowling alley. In my bowling alley, you know, that kind of thing. I'm a law firm and I have jury trials. There's a lot of stuff out there that could make you eligible. And it doesn't mean necessarily that, that you needed this money.
Yeah.
I think we've exhausted our jokes at the time, for now. So if you've got follow-up stuff, Anna Marie, feel free to email us about the rentals. That can get a little complicated and I'm not sure there may not be an actual answer for you. But we can discuss it and you can feel free to take that position, take whatever position on the return that you feel good about. But all right, well, thanks guys. We appreciate it.
Thank you.